Hello and welcome to Money Matters. Over the last few months, Bitcoin's value has roller coastered at least 50%, both up and down, causing analysts and laymen alike to speculate how the cryptocurrency should be valued. Often called digital gold, it's similar to gold. But what are the fundamentals behind it? And is the connection to the yellow metal enough to give it staying power?
It was actually at the end of 2013, which is when Bitcoin first reached $1,000 very briefly. And I remember being in the elevator in ICC, and it was Bloomberg playing in the elevator, and they were talking about this digital money, which went from $1 to $1,000 within a couple of years. And that's when I thought, like, that looks weird, interesting, but let me look further into that. That was the very first time I even heard the name Bitcoin.
Max, who prefers to keep his identity private, is an ex-investment banker as well as a mathematician and theoretical physicist. He bought his first stash of Bitcoin in 2014 and bought the dip that year.
The price dropped by half down to 200, but I decided I'm going to buy some more. And then I think 9 months later, it hit $600 per coin, and I decided to sell it all, which at the time seemed like a great investment, but in hindsight, it wasn't.
Bitcoin's valuation is what stumps most people. Some measure it with the same fundamentals used to value commodities or assets. Does it generate income the way property does? Does it have a use like gold, which is used to make jewelry and is seen as a store of value, even if it isn't used as a currency?
To me, it is a much better version of gold, a digital version of gold, but it has so many other utilities as an underlying layer of a totally new financial system, because you can use it as collateral for other financial contracts and even functions better as a store of value than gold itself.
Max made a deep dive into crypto in 2017, researching the details of Bitcoin and Ethereum. His initial view of it was as a digital currency that would simply make transfers as fast and easy as sending and receiving email. He realized it was a real investment asset. He invested more that year, and with its growth, Bitcoin now makes up 50% of his investment portfolio.
Within that space, the breakers, I probably have about 35-40% in Bitcoin, 20% in Ethereum, and the rest distributed over about 10-15 smaller, more risky digital assets.
Ben Quinlan, chairman of the Hong Kong Fintech Association, is a Bitcoin skeptic and questions its valuation.
I think if you go out into the market and you ask people, what is Bitcoin worth? The professional analysts and even the people on the street will say anywhere from $0 to $1 million. And I've never seen any other asset class in the world have that much variability in its forecast price.
He says his financial consultancy firm came up with 4 fundamentals to try to value Bitcoin: the cost of its production, a store of value like gold, foreign exchange reserve, and its use for payments.
But all of those things pointed to it's not worth what it was.
According to a Cambridge University study on the cost of Bitcoin production, also known as mining, this uses more electricity annually than the whole of Argentina. And what about as a form of payment?
Will it ever replace a legitimate form of currency? No, and I think that the growth of central bank digital currencies is really going to act as the primary challenger to that, and that's really going to thwart the business case for something like BTC rising and becoming an alternative form of mainstream payment.
Ben sees value in Bitcoin and other cryptocurrencies as an investment asset.
It's very liquid, very well traded. So, it's an asset class that an institutional mindset could get familiar with, or a professional trader could start to say, hey, there's a lot of opportunity here, right, for arbitrage, for staking, for all these other things that you could do in traditional financial markets, which you can now do in crypto land.
He suggests that part of what's driving its valuation up is the fact that institutional investors want in on the action, and this is raising its credibility. Henri Aslnanian, PwC's global crypto leader, agrees.
Very close to being the fact that now we have some of the large custodians, the banks like BNY Mellon, Northern Trust, some of the banks, the household names that we all know very well, banks like DBS, JP Morgan, and others, and as well as some of the large asset managers that are entering the space. Really, those can have an outsized impact that it can have a more meaningful and long-term impact on the value and the price of Bitcoin than the simply daily back and forth, daily volatility of the price of Bitcoin.
Henri says Bitcoin's finite character in the current environment of endless quantitative easing or printing of money gives it value as a hedge against inflation.
Over the last 12 to 18 months, we saw an increased number of not only individuals, but also a lot of fund managers and corporations started looking at Bitcoin as a hedge against inflation, and as a kind of a hedge against a potential currency devaluation, as well as being as a store of value.
With a zero interest rate environment and equity markets seen as inflated, the cryptocurrency market is looking attractive to many investors. Institutions wanting to roll out this new asset class to their clients have been knocking on Alessio Quagliani's door. His company provides institutional-grade investment platforms. He's currently working with 3 banks to get them into digital assets.
In the past 6 to 9 months, our business has probably grown tenfold, and the number of inquiries is increasing every day. Towards the end of last year, we've seen a steep increase in the interest of traditional financial institutions. Basically, every major bank taking the first steps to enter this market.
He says customers look for custodial services, storing and securing digital assets for institutions with high net worth individuals, family offices, and retail investors. He says he expects to see these services rolled out by next year. But with all the interest in digital assets, the Securities and Futures Commission is limiting investments into these assets to professional investors only, those who have 8 million Hong Kong dollars in liquid assets. Henri says this is an outdated way to regulate a market.
A grandmother that has no knowledge about finance, knows nothing about buying and selling or markets, but has 8 million Hong Kong dollars in cash is totally acceptable to be trading Bitcoin tomorrow morning. On the other side, somebody that is an expert in Bitcoin and trades for hundreds of millions of dollars of Bitcoin a day and knows the topic inside out cannot trade with these platforms because he doesn't have 8 million in liquid assets, excluding cryptocurrencies, in his name, and which frankly is a very outdated way of looking at customers.
Max says he welcomes any regulations that protect investors.
Regulators have to be very careful in not overdoing it, and with heavy-handed regulation, you're likely to actually drive innovation away. So while I think it's good that the Hong Kong regulators are looking at it and are trying to protect retail investors, I think banning retail investors entirely is just the wrong way to go, because it will have these unintended consequences that it will push retail investor into the unregulated market and probably make it much more risky.
Alessio says regulations for the digital market have to be balanced so that Hong Kong doesn't lose out to other jurisdictions that are more digitally progressive.
Companies operating in this market will have the certainty that they will be able to be competitive if they decide to operate the business in this jurisdiction. And currently, we're seeing a trend of several companies moving to other jurisdictions given the current uncertainty.
Where are they moving to?
Mainly Singapore.
Singapore knocked Hong Kong off the top of the freest economy in the world list in 2020 after 25 years running. This year, Hong Kong was off the list entirely. On top of excluding retail investors from this new asset class, Ben says it could widen the divide between the rich and the poor.
You can imagine being a retail investor, seeing that only the wealthy can invest in this asset class, which has gone up X thousand% in the past however many months. That doesn't necessarily send the right optical signal. And I think that, yes, shutting off this kind of part to a retail investor when you're seeing such a big wealth divide between the rich and the poor, and that's only getting worse, that for me is just a broader question around social unrest.
For now, investors are eyeing a new frontier of digital assets and hoping to uncover true digital gold.